Are we prepared for a financial storm? Today's insights could change your investment strategy.
Absolutely. Leading analysts like Danielle DiMartino Booth are here to share crucial perspectives.
Plus, you'll get these crucial insights distilled into minutes, perfect for any busy investor.
Exactly. We're breaking down the BRICS expansion and its implications on global finance.
Welcome to Financial Insights in Minutes, where we streamline complex information to keep you informed.
Stick around for Steve Hanke's critical warning about the election's potential economic fallout.
Joining me today is Todd Sachs, and we're diving into the heart of Federal Reserve policy and how it shapes the lives of everyday Americans.
Absolutely, Danielle. Having this conversation is crucial, especially given the complexities that emerged during recent monetary policy changes.
What do you think has been the most significant impact of these policy shifts?
It's the redefinition of home ownership. Homes are now viewed more as financial assets than as places to live.
That's a striking change. And what does that mean for many families today?
Families now find themselves trapped in a cycle of debt without the security they once had.
So let's start with how the real estate market has evolved.
It's shifted dramatically. Homeownership was once a secure investment, but now feels precarious.
What about baby boomers? How are they faring with these economic pressures?
Many are returning to work, which signals serious shifts in financial security.
It seems like the younger generation is facing unique challenges.
Definitely. They need more motivation to engage in the workforce amid high costs and economic uncertainty.
Some experts predict that we may see the Fed buying stocks if the market tumbles.
That's right. The Fed's past actions suggest that they might prioritize market stability at all costs.
To sum it all up, the implications of Fed policies are more impactful than we may realize.
Absolutely. As we move forward, families must reassess their financial strategies accordingly.
As the elections draw near, we have esteemed economist Steve Hanke here to discuss some pressing economic concerns. Let's dive right in.
Thank you for having me. The election is indeed intertwined with economic issues this year.
What's the root of your concerns leading into this election?
We've seen drastic swings in monetary policy and a government that overspends, which cannot sustain itself.
So you foresee a recession as a likely outcome?
Absolutely. A contraction in the money supply will likely lead us there.
You mentioned a roller coaster with monetary policy. Can you elaborate?
After the pandemic, we saw a huge increase in money supply, leading to inflation, which is now reversing precariously.
What are your thoughts on the current state of government spending?
The sheer accumulation of debt is alarming. The U.S. is facing unsustainable levels that could trigger a financial crisis.
You're drawing a direct line between these policies and wealth inequality, correct?
Yes, the rich have significantly benefited while the lower classes are left behind.
What's your outlook for the economy if these trends continue?
Without significant changes, we're heading for an economic downturn.
What sort of predictions are you making for the next economic period?
If we carry on this way, I predict we'll see a recession as early as next year.
To wrap up, what can viewers take away from your analysis today?
A thorough reassessment of our monetary and fiscal strategies is crucial to prevent a recession.
Certainly a lot to ponder as we move towards potential fiscal changes.
It's all about being proactive rather than reactive.
In today's discussion, we're diving into the insights shared by Peter Grandich regarding the recent BRICS summit and its implications for the U.S. economy.
Peter warns us that the U.S. might be heading into one of its most challenging periods in history. So let's unpack this.
So what is it that Peter foresees for the U.S. based on these economic signs?
He believes that our national debt, projected to reach $36 trillion soon, will create a financial crisis that many aren't prepared for.
That's quite a sobering outlook. What are the implications of the BRICS and their emerging influence?
Peter suggests that BRICS nations are strategically moving away from the U.S. dollar, paving the way for a new world economic order.
What were the key takeaways from the BRICS summit, Peter?
The summit showcased a recalibration of international relations, with leaders seeking to establish new trade dynamics that bypass the U.S.
Interesting shift. And how does gold fit into this landscape that you mentioned?
Central banks are accumulating gold. It's indicative of a potential pivot towards backing currencies with precious metals.
Given these circumstances, how is the U.S. economy positioned?
Peter highlights a dangerous trajectory. Rising debt coupled with insufficient governmental responses risks igniting a crisis soon.
What role does the political climate play in this prediction, Peter?
The current political division hampers necessary economic reforms, and this inefficiency is likely to deepen economic challenges.
In light of these challenges, how should investors be strategizing?
Peter insists on a shift towards preserving capital rather than chasing unrealistic returns. Safety first.
Peter, could you elaborate on your economic crisis prediction?
Certainly, he foresees the economic fallout as an inevitable consequence of unchecked national debt and geopolitical disarray.
What can we expect in the gold market amidst these changes?
Peter anticipates a bullish trend for gold as it becomes a critical asset amidst economic uncertainty.
To summarize, what should our viewers take home from Peter's analysis?
The key takeaway is to prepare for potential upheaval, stay informed, and focus on protecting your investments.
Thank you, Peter. There's a lot to ponder as we move forward.
Absolutely. Understanding these dynamics is crucial for all of us.
Today, we're shedding light on a significant market shift, the end of a 6-week winning streak for stocks. What better way to understand this than with Lance Roberts?
It's definitely a pivotal moment. After such gains, investors need to reassess their strategies going forward.
Now, what's the overarching thesis here that Lance lays out?
He suggests this winning streak may have created a false sense of security, warning that many economic factors could lead to volatility.
Interesting. What are those economic factors that might catch investors off guard?
Interest rates and inflation are two major players that could upset the current balance.
Lance mentions that investor bullishness peaked during the winning streak, but does this create complacency?
It definitely can. When everyone is riding high, risks tend to be underestimated.
How do rising inflation and interest rates complicate matters?
Higher rates typically restrict investor borrowing and spending, leading to potential market corrections.
Lance suggests broader trends may place pressure on the stocks. What does he mean by that?
He indicates that various sectors are beginning to show signs of weakness. It's a sign that profits could retract.
What should investors be doing right now?
Reassessing their portfolios, especially looking at risk levels. Some might need to buff up on safe haven assets.
All right, what's Lance's outlook for future market volatility?
He depicts an environment where volatility is the norm. Investors need to be ready.
So, what should we expect from the stock market in the coming months?
Look for heightened fluctuations. It's likely we won't see the same upward momentum for a while.
So essentially, stocks might be on a roller coaster ride.
Exactly. Buckle up, it could be wild.
Lance hints at a potential rise in safe haven assets. What can we expect there?
Indeed. With increased uncertainty, both gold and silver will likely attract more investors seeking stability.
Once again, gold proves its worth during turbulent times.
Absolutely. A classic flight to safety strategy.
What's the final takeaway from Lance's insights?
Investors should prioritize risk management. Being prepared to pivot is crucial in this evolving market landscape.
Sounds like staying adaptable is the name of the game.
Exactly. Navigating these changes will require strategic flexibility.
In this video from Eurodollar University, the Federal Reserve's latest revelations about the economy point towards concerning trends amidst general confusion.
Indeed, rather than signs of recovery, the Fed's insights reveal growing economic issues that challenge the prevailing assumptions.
What's the core argument put forth?
The Fed's decision to cut rates is a signal of serious economic deterioration rather than a panicked response to market volatility.
That's a critical perspective. What prompted this dramatic action?
Clear signals like rising unemployment, manufacturing slowdowns, and increasing credit delinquencies.
Let's delve into these signals of economic contraction. What's catching your attention?
The spike in loan delinquencies is alarming and indicates deeper consumer struggles.
What's happening in the manufacturing sector?
It's a stark contrast. Most areas now indicate not just stagnation but clear contraction.
How is the Fed responding to these conditions?
Their actions, like the recent cuts, are clearly in response to the worsening economic indicators.
What does the tightening of credit standards signify?
It suggests that banks are bracing for losses as consumer credit quality diminishes.
So how do these narratives play into market behavior?
They often diverge from the real data, causing confusion and misinterpretations among traders.
What does the future hold in this deteriorating economic context?
predictions indicate a continuation of rate cuts and possible further economic struggles.
To wrap this up, what are the key takeaways for viewers?
It's imperative to remain cautious. Current economic signals starkly contradict any narrative of recovery.
In today's market analysis, we're diving deep into volatility spikes and what they mean for traders.
Absolutely. Tesla just made the biggest move in 11 years, and we're here to unpack that.
So what's the crux of the current volatility?
The VIX is hinting at significant market changes ahead, with tech earnings set to drive sentiment.
Interesting. How does past performance give us clues about the future?
Historically, VIX spikes have often correlated with market highs and subsequent corrections.
What do the current VIX levels tell us?
We are at a critical point. Historically, major market moves often follow.
Are tech stocks the main focus this earnings season?
Yes, especially with volatility running high, results are crucial.
What is the outlook for the Nasdaq?
If history is any guide, we could see a bullish trend into year-end.
What about small cap stocks? Are they worth watching?
Definitely. They might finally catch up as large caps stabilize.
How should investors prepare for what's ahead?
Caution is key. Look for buying opportunities during dips.
What are the predictions for the year-end correction?
We might see 4 to 6% drops, but opportunities will follow.
What about Tesla's future after this massive jump?
It may push towards $300, indicating strong momentum.
So, what should viewers take away from today?
Focus on staying informed and look for opportunities amidst the volatility.
It's clear that adapting to market changes can reward savvy investors.
Exactly. Embrace the trading mindset and be prepared.
What an insightful discussion we've had today. Each guest brought a unique perspective on the current economic climate.
Absolutely. Danielle DiMartino Booth highlighted how Fed policies are shaping consumer behavior, especially in real estate.
And let's not forget Peter Grandich's warning about the potential repercussions from the BRICS summit.
Right, and Steve Hanke agrees, emphasizing that unsustainable spending isn't just a political issue, it's a looming threat to the economy.
Tom also pointed out that despite volatility, there are still bullish signs in smaller sectors, which could offer opportunities.
Great takeaway. Cautious optimism seems to be the name of the game right now.
Thank you for joining us and for diving deep into these crucial insights. If you found value in today's discussion, don't forget to like and subscribe.
By subscribing, you ensure you won't miss out on updates that could safeguard your investments in uncertain times.
And be sure to explore our other content here on Financial Insights in Minutes to stay informed.
Till next time, keep your investments secure and your mind open. See you soon.